Dr. Velumani, Chairman and CEO, as well as Managing Director of Thyrocare, joining us. Thanks so much for joining us, Doctor. When we look at the organized space, growth in all the 3-4 listed players has been very strong. Are you seeing a shift from unorganized to organized now?
For the last 10 years, this has been happening. People were not brand conscious. Today, people are looking at brands. And brands are also communicating, so brands are visible. So moving from unorganized to organized has been happening. But the speed at which it is happening is very slow. It might take not less than another 20 years to see a 20% organized market. Today is hardly a 5-7% organized market.
And when you look at volume growth, it's picked up in a fast manner from unorganized to organized. Do you think the pace will now be faster?
No, I would say it is too small a motivation. The industry has been having unorganized players recklessly operating, no controls on their quality accreditation. In fact, they don't pay tax at all. So it is that the number of players getting into the space is much faster than even the growth of the industry. So having said that, we see a shift from unorganized to organized, but not as much as one would love to see it.
Right. Mr. Velumani, but do you think this is the start of this shift from growth in unorganized to organized? And do you think this will continue as branded players are focusing?
I think the media through which they reach to the common man might vary, but they are reaching. But having said that, once we have become listed, we are looking at the numbers every quarter. Earlier, we were only seeing yearly. Yearly fluctuations were far less. Quarterly fluctuations are far high. So if you ask me quarter to quarter basis, I have to give a commentary. It's very difficult to give. But overall, this year, the growth would be better for all the 3 organized players.
Right. Do you think growth in preventive care is one of the key reasons for the shift in organized space, or people are shifting genuinely into organized space altogether?
Yeah, in that way, there was nothing known as a preventive care 20 years back. But slowly you find today the industry having a 10% of the total turnover as preventive care. The branded players having better market share than the unbranded. So overall, the preventive care is growing because there is an increased awareness, there is an increased per capita income, and also rates are quite competitive, and also decibels are very high. So I think every balance sheet of all the organized players, listed players, is supported by the preventive care or the wellness packages.
Now, we had seen PE players 5 years ago very active in the markets, but has there been, a stop to that, and would, pricing be the key reason?
I must tell you, the tsunami is over. Though it might take some more, time for the rains to stop, but the tsunami is over. For the last 3 years, all PE guys went overboard, thinking that creating a $1 billion company is just a couple of millions of investment. But it is not so. The industry has become so tight, the pricing has become so intensely competed. Today, there is a way in which I will define, without this rate, this volume is not possible. And without this volume, this rate is not possible. So the PE guys have understood, after only burning adequately on their runway, they couldn't take off. Now there are only smoke around, according to me.
And when we look at the B2B and B2C players, there was a heavy discounting. Has this now seen some rational pricing?
I think B2C as a segment, the price competition is not sensed, because common man does not know what test costs how much. He has no knowledge of what is MRP, because it's a service. There is nothing truly known to the common man. So B2C players have a comfort, and they don't have true competition, what you call as in a large scale. But B2B, where you are dealing with another businessman who knows what is business, he knows what is costing, he knows what is pricing, and he knows all calculations. And I am in a B2B space almost 80% of my business in B2B. So this B2B was supposed to have got disrupted because of the aggression of the PEs for the last 4 or 5 years. In fact, I was thinking they might be successful, but today, at least for the last 6 quarters, I am seeing there is a silence of the so-called disruptors in the B2B market.
So, following an FY19 margin decline on the back of price cuts, do you expect margins to stabilize going ahead in FY20?
I think this industry, the margins are not challenged there as what it is, though each player could have his own percentage margin based upon his business model. Mine is a light business model where I don't run the restaurants, I only run the kitchen, and my business has a better EBITDA. But if you notice, for the last 2-3 years, we haven't had challenge in the profitability, though we had challenges in the growth. So we are back, growth will be back, EBITDA will be continuing. I have a reason to believe this EBITDA is sustainable at least for 5 more years.
Right. Mr. Velumani, Thyrocare is focused on being the lowest price player. Does that continue to be your strategy for growth to gain your market share as well?
I think I reached to the market with the B2B as a business strategy, and B2B is very price sensitive. My services for B2C is not truly cheaper, but my services to B2B is very, very affordable. I am of that opinion. I am cheaper than the reagent for the B2B, and they will continue to grow and support, and profitability in that rate itself is sufficiently high for me. There is no need to sit and grumble.
Okay. On that note, Mr. Velumani, we'll let you go. Thanks so much for taking the time out and speaking with us today.